Good evening to all the viewers. Uh, by way of introduction, I am Devang Ambavi, Chartered Accountant and proprietor of a firm, Ambavi Associates. My firm specializes in providing tax and regulatory advisory and compliance services. I'd like to thank LAJA Group for inviting me to present to their members and all the viewers the key proposals of Union Budget 2019 as presented before the Parliament by our Finance Minister on 5th July 2019. Being an election year, the year of 2019 saw Union Budget in two phases. We saw an interim budget in February of this year, and as expected, the interim budget had provided certain policy level and changes from a tax perspective, which benefited a large set of taxpayers. Arguably, these proposals were suggested or enacted keeping in mind the upcoming general elections. And in the first budget of Modi 2 government, the taxpayers were hoping that the government would continue from where they left at the interim budget. To list out the key expectations from the government, the hope was that the limit of 1,50,000 rupees for deduction under Section 80C, which an individual taxpayer gets when he makes payments towards insurance policies or deposit under a public provident fund account. This limit, which is capped at 1,50,000, was expected that this budget would have increased such limit. Similarly, to give a boost to a real estate sector and with the dream of providing housing for all, the limit for deduction of home loan interest, which is currently capped at 2 lakh, was expected that this limit be enhanced as well. Similarly, to rationalize the entire capital gain structure and eliminate the dual taxation, the expectation was that the government either reduces the STT rate or eliminates the dual taxation of STT and capital gains tax. Another expectation was also to align the tax rate for LLPs and keep it in line with the companies which are currently taxed at 25%. While I've listed down the expectations, at the same point of time, the taxpayers were also apprehensive about introduction of a new tax regime in form of inheritance tax or wealth tax 2, as it may have been called if it was enacted. Inheritance tax and wealth tax both would have provided a new stream or new revenue stream to the government and would have also made up for the deficit which the government incurs in providing benefits to in the interim budget. In the session today, I'll take you through what were the key budget proposals, and the proposals are divided into two parts. Firstly, I'll discuss the key initiatives at the policy level, and secondly, I'll take you through some of the key tax proposals. The finance minister presented the vision for the decade. The focus of the government is to take our economy to $5 trillion in next 5 years. In 2014, when this government took charge for the first time, it was at 1.85 trillion. Currently, when the budget proposals were presented, the economy stands at 2.7 trillion, and the expectation is to take it to $5 trillion in the next 5 years. To lay the foundation of the $5 trillion economy, the government's focus is on infrastructure development, investing in new age digital economy, bring out financial services sector reforms, and several other long-term structural reform measures. Let's discuss some of the key initiatives which the government has taken on this front. To boost rural economy, two initiatives which come to my mind is the Ujjwala Yojana and Saubhagya Yojana. Both of these programs put together have transformed the lives of every rural family. The government's mission to provide clean cooking gas to rural India, and under this initiative, they have provided more than 7 crore LPG connections in the country. In addition to that, households have also been provided with the electricity. The target which they have set for 2022, which is also 75th year of our independence, that every single rural family in the nation should have access to electricity and clean cooking facility. Another important initiative for uh, rural upliftment and rural empowerment is Pradhan Mantri Awas Yojana. This program aims to achieve the objective of housing for all by 2022. So far, government, so far, 1.54 crores rural homes have been completed in the last 5 years. And in the second phase, which is by 2022, an additional 1.95 crore housings are proposed to be provided to eligible beneficiaries. Housing for all, in addition with the cooking gas and and electricity amenities, these all put together should transform the lives of the rural Indian in the next 5 years. Another important point which the government mentioned in the budget was they are proposing to promote rental housing, and in this regard they are will bring up a model tenancy law which will be discussed and finalized after discussion with the states. So the expectation is that housing for all initiative will also promote rental housing and, so to say, the co-living spaces, which is very prominent in the Western countries. This year, we before the budget, we saw government making a very important announcement in the area of water security. India's water security and providing access to safe and adequate drinking water to all Indians is one of the main priority of this government. A major step in direction has been the constitution of Jal Shakti Mantralaya, integrating the water resources, river development and Ganga rejuvenation, and Ministry of Drinking Water and Sanitation. This new Mantralaya will look at the management of water resources and water supply in integrated and holistic manner. This Mantralaya will also work with states to ensure Har Ghar Jal program, which in a sense every rural household by 2024 should have drinking water facility. Another important initiative which has been a great success is the Swachh Bharat Abhiyan. This noble scheme was initiated way back in 2014 and has so far achieved a resounding success. 9.6 crore toilets have been constructed since 2014 and more than 5.6 lakh villages have become open defecation free. It is proposed to expand the Swachh Bharat mission to undertake sustainable solid waste management as well in every village. Keeping all these important points together, about the electricity, water conservation, housing for all, and Swachh Bharat mission, all programs put together would definitely go a long way in rural development and giving a better living for our rural India. The government also finds a special mention in the budget about women upliftment. The finance minister read the lines of Swami Vivekananda where he said, "There is no chance for the welfare of the world unless the condition of women is improved. It is not possible for a bird to fly on one wing." With this thought in mind, the government mentioned that they have supported and encouraged women entrepreneurship through various schemes such as Mudra Yojana, Stand Up India, and the Self-Help Group movement. In order to further encourage women enterprise, it is proposed in this budget to expand the Women Self-Help Group Interest Subvention Program to all districts. Further, for every verified Women Self-Help Group member having a Jan Dhan bank account, an overdraft of 5,000 shall be allowed. In addition to that, one woman in every self-help group will also be made eligible for a loan up to 1 lakh rupees under the Mudra scheme. This initiative, I would believe, would go a long way to promote women entrepreneurship in rural India. Moving on to the financial service sector, from financial service sector's perspective, the government has assured that they will provide the much needed capital to the PSU banks. It is proposed that the public sector banks will now be provided 70,000 crore capital to boost credit. To further improve the ease of living, they will also be leveraging upon technology, offering online personal loans and doorstep banking and enabling customers of one public sector bank to access services across all public sector banks. This, in a way, would kind of give flexibility for a customer to transact in an even manner across all public sector banks. Focus of this government is also to upgrade the 1,25,000 kilometer road network, continual expansion of the metro rail projects, enhanced focus on effective and efficient utilization of waterways, essentially to help reduce road congestion and making India a hub for maintenance, repair, and maintenance overhaul for the aviation industry. These were some of the key policy level initiatives which were proposed by the government. It is expected that the impact of these proposals should bring the change in India which the government had promised us in the general election earlier this year. Moving on, let me take you through some of the key tax proposals which were presented by the finance minister. While presenting the tax proposal, our finance minister read a poetry stroke verse in Tamil, and thereafter she translated that in English, which I'll just read out as follows. A few mounds of rice from paddy that is harvested from a small piece of land would suffice for an elephant. But what if the elephant itself enters the field and starts eating? What it eats would be far lesser than what it would trample over. Well, she didn't explain whom she referred as an elephant or the rice, but on the lighter note, from the taxpayer's point of view, there appears to be an elephant in the room which needs to be handled with utmost care. So, from tax policy level announcement perspective, one of the main initiative which the government has taken is to promote electric vehicles. Government's vision is that India becomes a global hub of manufacturing electric vehicles. In this regard, government has taken various steps from GST point of view, and in this budget have also proposed certain amendments from an income tax standpoint of view. In the past, the government has already requested the GST Council to lower the rate of GST on the electric vehicles, which is currently at 12%, to reduce it to 5%. And to ensure that electric vehicle is more affordable to consumers, additional income tax deduction of 1,50,000 Indian rupees on interest paid on loans to purchase electric vehicles is being proposed. What it means is, if a taxpayer takes a loan to purchase an electric vehicle, and any interest paid on that loan is generally allowable as deduction against the income which the taxpayer earns. In addition to that deduction, a deduction of up to 1,50,000 will be additionally allowed to the taxpayer. Moving on, important amendments which the government has proposed which will help is the startup community. Currently, a good number of startups are facing the so-called angel tax issue. To give you a background about this issue, the funds which are contributed by the investors in a startup company are being scrutinized by the income tax officer. In practice, this income tax officer would ask details about the price at which the investment happened and would also want to evaluate the credibility of the investor who has infused the funds in the startup companies. Media reports suggest that investments by some of the reputed investors and HNIs are being questioned by the assessing officer, and in many cases they have made adjustments to the income of the startup, thereby doubting the genuineness of investment and also questioning at the price at which the investor had invested. And as I said, many of these investments were by reputed HNIs and reputed HNI investors. Many of these cases are now pending before the court of law, and which has resulted into long drawn litigation. In the past, the government had made an attempt to resolve this AG tax issue, but the results have not been encouraging. In this budget, what the government has proposed is the startups and the investors will file requisite declarations and will provide the information in their income tax returns. And once this information is provided, the startups will not be subject to any kind of scrutiny by the income tax department. The issue of establishing the identity of the investor and source of his funds will be resolved by putting a mechanism in place of which will be kind of an e-verification in nature. In addition to that, special administrative arrangements shall be made by the Central Board of Direct Taxes for pending assessments of startups and redressal of their grievances. In effect, they will have assessments conducted in a manner whereby the adjustments are not done by the assessing officer on voluntary basis, or unless they take a prior approval of their seniors, no adjustments will be possible. Another amendment which will help the startup is about the conditions which they have relaxed for carry forward and set off of losses. Under the current provisions of the Income Tax Act, whenever there is a change in shareholding of a company, and if that change in shareholding exceeds the specified threshold, the company loses its right to set off the losses in the future years. For the startups, they have relaxed some of these conditions, and in effect, even if there is a change in shareholding, the startups will have an ability to set off the past losses against the income of the future years. Moving on, for realization the goal of housing for all and affordable housing, current provisions of the Income Tax Act already provide a tax holiday to the profits which are earned by the developers on the affordable housing project. Also, interest paid on housing loans is currently available as a deduction to the extent of 2 lakh, where such house is a self-occupied property of the taxpayer. To provide additional benefit in this budget, it is proposed to allow an additional deduction of 1,50,000 Indian rupees for interest paid by an individual when he purchases affordable housing and he takes loan for payment of the house which he's purchased. There are two conditions where the individual taxpayer needs to comply with. A, the value of the affordable house should not be more than 45 lakhs, and second, the interest paid on loans should be borrowed up to 31st March 2020. This amendment would help individuals who are looking to buy a house which qualifies as an affordable housing project and who takes a loan and in a way gets an enhanced interest deduction of up to 3,50,000 Indian rupees. Another one of very important amendment which the government has proposed is interchangeability of PAN and Aadhaar card. Currently, if an individual taxpayer needs to file a tax return, he needs to necessarily have a PAN card. The process involves doing the registration on the income tax website using the PAN card, and once the PAN details have been provided, the data of the individual taxpayer is automatically captured. The government now proposes to integrate Aadhaar number in the Indian tax system as well, whereby an individual, even if he does not have a PAN card, has an ability to file his income tax return by using his Aadhaar number. What it means is, we currently have more than 120 crores individuals who have Aadhaar card, and a very small proportion of taxpayers who have PAN, and out of all the individuals who have PAN, there is a small proportion which end up paying taxes and filing the tax return. The government's proposal to make PAN and Aadhaar interchangeably will allow all the individuals to file their tax return based on their Aadhaar card. Furthermore, the government is planning to amend the IT framework in a manner whereby the income tax return will be pre-filled with information such as salary income, capital gains on securities, bank interest, dividends, and tax deduction. The government will get this entire information from banks, stock exchanges, mutual funds, fund managers, and various other agencies. According to me, this could be a pathway breaking step in the field of tax compliance and tax administration. Assuming information about the financial transactions is tracked through their Aadhaar, soon government will have a big data about the citizens and specifically about those citizens who do not apply their PAN and do not code their PAN in the financial transactions. And these individuals may have never filed their tax returns, but now the government will have their information because these transactions are linked through Aadhaar. So indirectly, it will bring 120 crores Indians into the tax system and hopefully a new set of taxpayers as well. In this budget, the government has also taken series of steps to promote digital payment and discourage cash expenses. A levy of TDS of 2% on cash withdrawal exceeding 1 crore in a year from a bank account is being proposed. It is important to note that the 2% TDS will apply where the withdrawal is more than 2 crores and the limit of 2 crore will be computed based on each bank account of the taxpayer. It is also important that the tax so deducted will be available to the credit of the taxpayer and he could utilize such taxes against the other tax payment which the taxpayer would have. To promote digital payments, the government has proposed that the business establishments whose annual turnover is more than 50 crores shall offer low-cost digital modes of payment option to their customers. To ensure this is more viable or workable, no charges or merchant discount rate shall be imposed on the customers as well as merchants. Government has requested RBI and the banks to absorb these costs from the savings that they will accrue to them on account of handling less cash on account of less cash which moves within the people. And to ensure these provisions are enforced, it is proposed to levy a penalty of 5,000 every day where an establishment whose annual turnover is more than 50 crores does not have a procedure in place to accept payment in digital mode from its customer. On the corporate tax side, there is no change in the tax rate, and in fact, the corporate tax rate of 20%, which till last year was available only to taxpayers whose annual turnover was 250 crores, that limit has now been increased to 400 crores. So what it means is more than 99% of the corporate taxpayers will be eligible for this reduced tax rate of 25%, and only handful of the companies will be subjected to a tax rate of 30%. Having said that, there is no changes the government has proposed in the tax rate of LLPs. From an individual tax standpoint as well, there is no change in the slab rate. However, the budget proposes to increase the surcharge for individual taxpayers. The surcharge of 15% is proposed to increase to 25%, where the total income of the taxpayer is more than 2 crores but less than 5 crores. And surcharge is proposed to increase to 37%, where the total income exceeds 5 crores. In simple words, this translates into a tax rate of 39% for individual earning more than 2 crores but less than 5 crores, and 42.744% for individual earning income more than 5 crores. It appears the government has chosen to increase the surcharge for mega rich as against imposing a new tax in form of inheritance tax. Inheritance tax, if it would have been legislated, it would have require a significant bandwidth to administer and create other challenges, such as assuming a person would inherit a immovable property of say 1 crore, and the inheritance tax on such immovable property which is inherited is, let's say, as 5%. In such a case, the individual is required to pay 5 lakhs to the government in form of inheritance tax. In practice, It is possible that the individual may not have inherited cash and may not be in position to pay such taxes. Ultimately, he may choose to sell the inherited property to ensure he makes payment to the government treasury. This is one of the simplest example or a simplest issue one could face in inheritance tax. So fortunately, at least in this budget, the government has decided not to have any new form of tax, and instead they have chosen to increase the surcharge for mega rich individuals. Certain amendments have also been proposed in scheme of NPS. Under this scheme, upon retirement, an individual could have withdrawn a lump sum up to 60% of the corpus, and balance 40% was required to be invested in an annuity plan. In this budget, it is proposed to raise the exemption limit of 40% to 60% for the corpus fund. Another important amendment for individual and the HUF taxpayers is about the withholding tax, about TDS, which now they will have to withhold on certain payments. Under the current tax provisions, if an individual or an HUF is not subjected to tax audit provisions, and when he is making any personal payments, he is not required to withhold tax on payment of professional fees and payment to contractors. What used to happen, a large amount of these payments were made and they were made without any TDS. Government felt there was a good amount which is not coming into the tax system, and therefore to curb this issue, they have proposed to introduce a new section whereby there will be a levy of TDS at the rate of 5% on any sum which an individual or an HUF pays to a professional or a contractor. This provision would apply provided where currently the same individual or an HUF is not required to withhold tax, and the payments to resident exceeds rupees 5 million in a year. To ensure the compliance is not cumbersome, the government has proposed that PAN will be enough for an individual to make the payment to the government, and there will not be any additional requirement to obtain a tax deduction account number and file quarterly TDS returns. Another important amendment which the government has made is TDS on payment towards purchase of immobile property. Under the current provisions of the Income Tax Act, whenever an taxpayer is buying an individual property either from a developer or from a seller, he is required to withhold tax on such payments. The tax laws currently do not clarify whether the TDS applies on payment towards club membership fees or towards car parking fees or towards electricity or water facilities or for maintenance fees or similar other charges which the developer is collecting from the purchaser. These charges per se are incidental towards payment or towards acquisition of immobile property. In this budget, it is proposed that TDS portion will not only apply for the payment which is made towards immobile property, but also these additional charges. So going forward, any payment which is made by the individual towards these payments or towards these charges will be subject to TDS. Another important amendment for non-resident taxpayers is the budget proposals have amended the section whereby any property which is received by a non-resident taxpayer and where such property is received for inadequate or no consideration, such receipt shall be treated as an income and a taxable receipt in the hands of the individual non-resident. Before such amendment, arguably the non-resident could take a position that the payment is capital in nature, and because it is a capital payment, it does not result in any revenue to the individual non-resident. It is not subject to tax. However, going forward, such receipts will now be taxable. Having said that, transactions which are gift which are specifically exempt under the provisions of Section 56. Example, when one relative is giving gift to another relative, these genuine transactions, even though they are for inadequate consideration, will be still outside this new tax levy. Another important amendment which will impact a large set of investor community is tax on buyback of shares of listed companies. Currently, buyback of unlisted shares attracts additional tax of 20%. However, no such tax is payable in case of buyback of listed shares. So, in the listed space, whenever the company came out with a buyback offer, taxation of gains was tax was computed based on the purchase price of the shares, based on whether the shares are held as capital asset or business asset, and thereafter the individual taxpayer would pay tax depending upon his own tax position. This buyback offer helped the cash-rich companies to make payments to their shareholders and, in a way, avoid the payment of dividend option. From a tax standpoint, the dividend payment of dividend would have resulted in dividend distribution tax in the hands of the company. And additionally, and where the dividend is more than 10 lakhs, would have resulted in additional tax in the hands of the shareholder. Thus, buyback was a good tool for the listed company to distribute cash to the shareholders in a tax efficient manner. In this budget, they have plugged this option or plugged this loophole, and they have proposed that any buyback of listed shares will be subject to buyback distribution tax in the hands of the company. The income so received by the shareholder will be exempt from tax, and only taxation will be at the company level. It is interesting to note that in the past 1 year, more than 40,000 crores was distributed by IT companies to its shareholders in form of buyback. Time will tell whether buyback option has lost its shine, and whether the cash-rich companies adopt the dividend route for payment to their shareholders. Another important amendment which they have proposed is in respect of payments made to non-resident. Under the current provisions, whenever taxpayer defaults in the provisions of TDS, there are draconian in such a cases, the taxpayer is treated as a taxpayer in default, and he's subject to interest, penalties, and even prosecution provisions. However, exception to these rules was where the counterparty has duly filed his tax returns, has duly provided a copy of that return and furnished an accountant certificate, then even if there was a default, a taxpayer would not be, even if there is a default, the provisions of default in taxpayer would not apply. However, this benefit was not available when the counterparty is a non-resident. So in this budget, it is proposed that if, let's say, Mr. A is making a payment to a non-resident Mr. B, and he has not withheld tax, and Mr. B has paid the taxes, has filed the tax return, and has given the certificate to this effect to Mr. A. In this scenario, even though Mr. A has not withheld the taxes, he will still not be treated as an assessee in default. On the indirect tax fronts, largely the proposals are focused on simplification of GST, ease of doing business, promoting Make in India, and having an environmentally friendly and have taken measures to have an environment friendly atmosphere. The proposals on the GST front include single monthly returns, providing free accounting software to small businesses, and a fully automated refund mechanism. As regards customs duty front, the main theme in this budget has been to make in India and import less. What it means is the custom duties on many raw materials will be reduced, and more goods will be manufactured in India. As I said earlier, electric vehicles have been given a big boost. In a way, have, environmental issues have also been considered. Another important initiative is a dispute resolution scheme has been proposed for pending disputes of central excise and service tax matters. These issues, which are pending before 30th July 2019, will now be eligible under the scheme, except for few exclusions. The relief varies in a range of 40% to 70% of the tax dues, and also includes waiver of interest and penalty. Indirect taxes have also been proposed to increase on petrol, diesel, tobacco, gold, and various other products. With this, I come to an end to today's sessions. Happy to take up any questions any of the participant or the viewer may have. So we have a question: is rental housing a good idea in regard to our Indian culture? You think it will be well welcomed? Uh, well, I was invited to give comments from a tax standpoint and not from Indian culture perspective. But I'll take a liberty to comment that do not hurt anyone's sentiment. But the concept of rental housing is something which is not uncommon in a global scenario. Unfortunately, the laws in India which relate to rental housing are not recent. Some of these laws and regulations were drafted keep when the tenancy regulations were in place, and which currently we don't have those tenancy concept. What we have in a housing front or a commercial asset front is a lease agreement which will have a fixed tenure, right? So we don't have a legislation which kind of, or the legislation which we have doesn't in a way kind of capture the current scenario the way in which the lease agreements are drafted. So the intent of the government is to amend those laws and regulations. And as far as Indian culture is concerned, I would hope people are open minded, and you know rental, with the change in the laws on rental housing, it also achieves the dream of housing for all which the government has. So next question is, I was keen to know if there is any segments and opportunities or schemes there in the budget for the urban women as well. There is, so budget does not categorize a scheme for rural women and the urban women. What budget does is they have schemes in place which give mudra loans to women entrepreneurs. uh, these schemes or these loans will have certain criteria, and the criteria would relate to the existing income of the women entrepreneur and the type of business, etc., etc. So I would think the proposals in a way don't have a carve out that urban women do not or cannot avail these facilities. I would think if we have a genuine case where even if urban women is eligible for a scheme or the opportunity, uh, the relevant bank or the financial institution, will kind of, should respect that request, provided all the conditions are, complied with. Well, with this, I come to an end towards today's session. Concluding remarks. In my view, it's a promising budget. The government has done a balancing act of not introducing a new tax regime, which it could have to generate new revenue stream, and instead they have chosen to tax the super rich. Similarly, no additional tax benefits were provided, and instead, base corporate tax rate has been capped at 25% for a large set of corporate taxpayers, and an angel tax issue which impacted investor community and the startup community is expected to be put to put to rest in peace forever. So to me, these were some of the very important amendments which will help taxpayers by and large. So I'm thankful to Team LAJA for inviting me and to allow me to present my thoughts and to present my perspective on Union Budget 2019. And I'm also thankful to all the viewers for patient viewing and patient listening. Thank you. Have a good evening.